Welcome back. This is the fourth video in our Stock Volatility Box onboarding series. And in this video, we're going to get to the heart of it, how to actually read the Volatility Box models. Now in our last video, I showed you how to pull the models up using the charts page for your favorite stock or ETF. So this would be a good time to do exactly that so you can follow along. Now in this video, I'm going to show you how to read the models themselves. And to keep this simple, initially, I want you to focus on just three things on every single chart. The first is where price is sitting relative to the clouds. The second is whether we have a volatility box breach. And finally, the third thing that we'll talk about that I want you to pay attention to is the state of the clouds themselves. Now let's go through this one at a time. So number one, the clouds and where price is. When you load a name on an intraday time frame chart, you'll see these shaded bands around the price. We call these bands the volatility box clouds. The green clouds are above price, the orange clouds are below price. And what they're giving you is information around the expected range, the expected behavior of this current market given the current volatility. Now, most of the time, you'll see that price is just fluctuating in between the clouds. We don't touch either edge. That's our normal state, and that's telling you that price is currently in its default behavior, the model's being respected, there's nothing really for us to do. Now that takes us to number two, which is the volatility box breach. This is the one you're really waiting for, and there's, I think, two ways to use the breach information. But first, let's talk about what a breach is. A breach is when price is hitting at least our volatility box clouds on the aggressive models. That's what I would consider the bare minimum breach. Now we can of course breach the aggressive or the conservative clouds, but by default, in order to breach the conservative clouds, we must have also breached the aggressive clouds. Now when we have one of these breaches, that's what we're paying attention to. That's telling you that currently this move that's happening, it's bigger than normal, so pay attention to it. We need to determine if this volatility edge is one that we want to trade. Now there's two ways to use this breach information. One is to initiate new trades, and the second is to manage existing trades. Now if you're looking to initiate new trades, you can use the long side breaches, which means price has drifted down, it's hitting our lower volatility box clouds, and we're looking to go long as the place for new entry. I'll show you some setups in our next set of onboarding videos, which helps you piece together if you're looking for either the long or the short side setups, which is when we breach the upper clouds. So that's if you're looking to initiate a new position. Now, if you have an existing position that you're looking to manage your exit out of, maybe you want to sell a covered call, maybe you simply want to trim your position, or just being aware of when you expect this trend to die down. That's where you can use the breach of the upper models, both the hourly and the daily, as your clues of where you're expecting this trend to start to die down. So that would be the place to either initiate this covered call, trim your position, etc. So far we've talked about two things. We've talked about number one, which is the volatility box clouds, and number two, which is the breach when we actually know we have a volatility edge. We want to pay attention to this. Finally, we have number three, which is the state of the clouds. Now this is where I think a lot of people get it backwards. You'll oftentimes, or rather sometimes in some of these key volatile markets, see the clouds compress, pull in tight, and even invert. Now, when they invert, that's your very clear sign that this is not a quiet day. The markets in this case, the volatility is so high that the models have inverted, they've compressed. We want to either sit out of this market or be in the direction that we're seeing the pressure. So for example, if we're seeing bulls take over complete control, prices breach the upper models where we would typically expect a short and some selling pressure, we're not seeing it. Instead, the bulls are just running right over all of the shorts. That would be where you see the models invert. Again, your visual clue that, hey, bull strength is high. The expected range has now been blown out so far that the high to low is more than 2 times our normal range. This is a good time to sit out of the market. So let's summarize everything we just talked about, the three different things you want to pay attention to. First is price and where it is relative to the clouds. Remember, most of the times we're just fluctuating in between the upper and the lower clouds. Now, the times we do get a breach, that's when we want to be paying attention. That's when we know we have a volatility edge. We would like to then move on to assess, is this a position that we either want to trade, or do we have an existing position we can better manage with this information? And finally, for those key volatile days, the state of the clouds will give you a lot of information around when and if you want to even be trading. Now let's talk about the two different models because they each have their own purpose. Let's start with the daily models first. The daily models give you one level for the entire day. And because you have one level, it's typically much harder to reach. So when price does get to this level, especially our conservative daily models, I give it a lot of weight. When we do see the conservative daily models being breached on our scanner, that to me is one of my favorite setups, especially if we have one of those at the edge setups there. The second is the hourly models. Now, the hourly models give you a new level every single hour, and this is reading volatility in real time, and as a result, you're handed far more breaches than the daily throughout the session. That's because you might have volatility that's picking up in, say, a random hour that might happen later on in the day. Well, the hourly models still pay attention. They track that, hey, we currently have a volatility edge in a place where the trend is long. Let's take advantage of it. And that's where the scanner becomes really useful. Now, one more lever that you have available to you is the aggressive and the conservative levels. Now, aggressive volatility box models are typically where I like to start. And on quiet days, you'll find that the aggressive models are where you spend much of your time. Now, the conservative models are wider, they are harder to reach, and I do lean on them far more on things like earning days or during our peak earnings volatility, around FOMC events, or even in general markets where, say, the rest of the market is breaching mostly aggressive models, but we have these handful of sectors or key markets that are breaching their conservative models. I pay a lot of attention to those, especially if they're in the direction of the overall trend. What I mean by that is, say, if our market pulse is telling us we're in the stage of acceleration, we're getting a long side entry, and maybe that's even off of the daily conservative models, I'm a very happy buyer at those levels. That to me is a discount, a gift that's available there for the taking. Now, another way that you can use the volatility box models is by paying attention to the first hour. Right at the open, you'll notice that there's a huge spike in volatility, and oftentimes this huge spike will take us straight into the hourly volatility box clouds, especially in key markets. Maybe not the index markets, not SPY, QQQ, etc., but you will oftentimes see, say, a Microsoft or an Nvidia getting breached while the broader indices might not be. So that early morning volatility gives me clues around A, what stocks are in play, and B, if this is going to be a day where the models are being respected in both directions, or if I need to have a bias. What I mean by that is, let's say you have a morning breach alongside breach, and you actually see a very nice V-shaped reversal. Well, that's our clue that the model is being respected. We do have buyers lying around, and we should be happy to buy the next long side breaches because we have this confidence that buyers have stepped in before. They should be willing to step in again. Now, one last note that I want to leave you with, which is when you are looking at the scanner, it's very easy to just focus on the models alone. And simply because you see price breaching our models, you start to take that and run with it. I think it's very important to bring together the models with other clues like what is the big picture trend, what's the support resistance levels nearby, what's the market pulse stage, and use that to build a better picture because you can turn a really nice day trade into a much nicer swing trade. So let's bring this all together one more time. 3 different things to read. We have the price, we have the breach, and we have the state of the clouds. We have 2 different models to take advantage of volatility, the daily models and the hourly volatility box models. And each one of those models has the aggressive and the conservative. Get comfortable with these models. Try loading them on different symbols. Try playing around with them. You can even go back to see how these models have performed historically. Get a sense of what the breaches have been, how often we just fluctuate versus we see a breach, and see how volatility differs between your favorite markets. In the next video, we're going to put this to work, talk about actual setups we trade off of these breaches and the rules behind them. That's where this becomes a plan that we can actually trade. See you in the next video.